Alright, here we go. Let's start preparing the statement. So the first place you're going to start with the indirect method, which is the method we're working with, the first place you're always going to start is you're going to start with net income. Okay? The reason that we like to prepare these financial statements, the reason we like to use the indirect method is because we use the existing financial statements in order to prepare it. Okay, so we don't have to do anything special. We don't have to prepare any special statements all year long. What we do is we take the final balance sheet, the final income statement, the final information that we already have, and we're able to prepare the statement of cash flows from that. So that's what we're looking at here. So our first question to ourselves, looking at this comparative balance sheet here, is how much net income did the company make? Because that's the first place we're going to start. All right. So if you think about where does net income go at the end of the year? Well, net income actually ultimately winds up in retained earnings, right? So if you were to just look at this was 2007, this is 2008, you would say, well, last year we had $202,300, and this year we have $282,300. So we must have had $80,000 in net income. All right? It could be that simple. You might have to take it a step further, which we're actually going to take it a step further here. But if it were as simple as the only thing that happened to increase retained earnings during the year was $80,000 worth of net income, then that's the number we would begin with. Retained earnings, though, requires that you look at things a little bit more closely. And what I mean by that is, let's look at retained earnings. So here is the ledger for retained earnings. And we go to retained earnings. If you remember, there's a few things that go into here. You close out net income. If you remember way back when to your closing entries, you close out net income or net losses to retained earnings. You also close out dividends to retained earnings. So if you went to look at the ledger for retained earnings, you can see here's the 202 number from last year. Here's the 282 number that it is now. But more than net income happened in here. You actually had $108,000 worth of net income, but $28,000 worth of dividends were paid out. Well, this is the number that we're interested in. We're interested in this $108,000 since that's where we're starting their statement of cash flows from. So here we go, over to net income. We have $108,000, and I've got an Excel spreadsheet that I just began setting up here for this. So what we have is we've got $108,000. That is our amount of net income that we're going to begin with. And from there, we're going to start making some adjustments. You notice I already have here cash flows from operating activities because that's where we're starting. And I'll underline this whole thing just to keep it a little bit nicer. Our next step here is going to be our adjustments to that number. Adjustments to reconcile, this is going to be a long one number here, reconcile net income to net cash flows from operating activities. Yes, it is quite long. What I'm going to do is I'm going to move this $108,000 over since I have some room to work with here. Alright, so this is going to be where we start making our adjustments to that net income number. The idea is that we're trying to whittle it down until we get to cash. Okay, what actual cash happened from operating activities? Now there are things that happen to net income that are not cash affected at all. What kind of things can you think of that affect net income but actually don't have anything to do with cash at all? Now, if this were a live class, I'd wait for a response, but that'd be a little bit silly on here. So, if you can't think of anything, I'm going to help you out. What you might think of is you might think of depreciation. Depreciation expense. All right. Depreciation expense doesn't affect cash at all, but it does reduce your net income number. So with that, since it is really a non-cash item, what we're going to do, since depreciation expense really lowers your net income, we're going to add it back because we're trying to get back to true cash here. So we're going to add back any non-cash items. So we would add, oops, let me get the number. Okay, I made some slight adjustments here. I didn't like how long that line was, but you've got the adjustments to record net income to net cash flows from operating activities. The first one of those items that we're going to be looking at, as I said, was depreciation. So here we go. Here's depreciation. I'm going back to my information, my PowerPoint, to figure out how do we get that depreciation number. Well, if you think about the depreciation journal entry, what is it? It's always a debit. Oop, too far. It's always a debit to depreciation expense and a credit to accumulated depreciation. Now, accumulated depreciation is a balance sheet account. So if I went to accumulated depreciation building, which is on that information from earlier that I told you to print out or write down, If you went to accumulated depreciation building, you would see that it increased by $7,000. Well, that was the depreciation expense for the year. All right, because as I said before, you'd have a debit to depreciation expense, a credit to accumulated depreciation. So this $7,000 didn't affect cash in any way, and since I'm trying to remove anything that didn't have anything to do with cash, what I'm going to do is I'm going to add back $7,000. Get myself some commas, no zeros. Okay, $7,000. So this is going to be true with depreciation. It's going to be true with amortization. If you've got any types of expenses like that, if you remember, amortization is the using up of intangible assets. Any type of items like that are going to be add backs here. Okay, so now let's look at the next item. The next item is going to be gain. All right, gain on sale of land. If we have a gain or loss on anything, we're going to adjust for that. And the reason is because it really doesn't belong here. That gain on this, anything to do with land, if we're selling land or we're buying land, if you remember, that's really an investing activities item. But again, gains increase net income, losses decrease net income. So with that, we want to take it out of here because we're going to put it somewhere else in a little while. Okay, so if you looked at the statements from that company, Rundell Inc., you would see that there was a sale of land resulting in a gain of $12,000. Okay, you may not have been able to see that from the balance sheet, but this would have been additional information provided to you with the problem, which you'll also see something like this in your homework problems. Okay, so the sale of land resulted in a gain of $12,000. This gain increased net income by $12,000. So the thing is it doesn't really belong here. So what we're going to do is, if we have a gain, we want to almost reverse its effects. So if we have the gain on the sale of the land, what it had done before was a gain had increased our net income. So what we want to do is we want to pull it out of there. So we want it to come out. We want that $12,000 gain to come out of our net income. Now's where it starts getting really interesting. So you may have to remind me a few times on this. Don't feel bad about it. I'm sure my live class would like to remind me on this as well several times. All right, what we're going to be doing is we're going to be looking at current assets and current liabilities. First I'm going to explain it to you conceptually, and then I'll show you something that's somewhat of a cheat that will help you to work these out. But first we're going to do this the right way, and I'm going to explain it fully. All right, so we're going to be looking at the current assets and current liabilities. And what this next slide has is it's almost got it's got a little bit of a statement. I'm sure this is in your book, this graphic, and it kind of helps you understand what to do in each scenario. If there's an increase in accounts receivables, you do this. If it's a decrease in accounts receivables, you do that. All right, so this is going to help you after I give my explanation to you. All right, so let's look at each one of these in turn. And this is from that information, that first couple of slides that I've given you. All right, in 2007, we had $65,000 worth of accounts receivables. In 2008, we had $74,000 worth of accounts receivables. Okay, so now looking at this from a cash perspective, this is where you're going to have to get your head around this. If we've got an increase in accounts receivables from one year to another, what does that mean? That means that less people are paying us than did last year. All right, think about that. That means we have less cash in our pockets. Last year, people owed us $65,000. This year, people owe us $74,000. So really, from a cash perspective, we're a little bit cash poorer, right? So with that, this has been a decrease to our overall cash. So with that, that's going to be one of my adjustments. I'm going to decrease my cash by $9,000 in my statement of cash flows because my accounts receivables balance went up by $8,000. I'm sorry, $9,000. I'm saying 8. My accounts receivable went up by $9,000. That means I have $9,000 less cash to work with. So that was a decrease to my cash. Okay, so like I said, an increase in accounts receivables winds up meaning that I've got less cash to work with. So that's actually a decrease to my cash. So you can see here I've got changes in current operating assets and liabilities. An increase in receivables means I've got $9,000 less cash to work with. All right, so let's look at the next one. The next one says inventories. Well, last year I had $180,000 worth of inventory, and this year I've got $172,000. So that means I've bought less inventory, right? Because I had $180,000 last year, and I've got $172,000 this year. I have less inventory, which means I'm buying less inventory, which means from a cash perspective, I must have more cash in my pocket. So this decrease in inventory means that I actually have more cash to work with. So decrease in inventory means that I actually have more cash to work with. It's an increase to my cash. Okay, next one. Oh, actually, I'm going to pause it and I'll continue on the next step.